Hey, founders, Kirk Mitchie, I'm back. We are getting down towards the bottom of the funnel here, all right? So you have gone from curiosity about whether you're going to sell, you've checked all the boxes there, you've moved systematically down, you put your deal team together, you decided on who to include, who not to include, you've learned what an LOI is, you've learned how to compare offers, you've decided on whether you're going to take an earnout or not, or how to think about that. And you are getting down to the nitty gritty. And one of the most important questions you're going to ask, because it relates directly to what you would call kind of net proceeds, is how much are you going to pay in taxes on this? All right. All right. So if you structure it well, and let's say for simplicity's sake, in this case, you're the only owner, it's pass-through entity like an LLC or an S Corp, with the caveat that I'm not a CPA, but we've done a lot of transactions, you're going to pay capital gains tax. You may or may not pay state capital gains tax, depending on where you are, but you're going to pay federal capital gains on this. And you're probably going to pay a higher rate. Unless you've been taking big distributions, you might be paying a higher rate of capital gains taxes than you've ever paid before. And if you're in a high tax state like New York or Massachusetts or California or Hawaii, then you're going to pay state capital gains taxes too. It'll matter if, say, your buyer wants to do an asset purchase rather than a stock purchase. You're going to be subject to some state capital gains there. There are some other factors that go into this. So certainly, minimally ask chat what the answer is on this, but more importantly, get accounting advice on this. But you might be willing to agree to that asset purchase. It's a net benefit for the buyer in many cases because they get to write off part of the proceeds over time if they do it that way. If you've got the right attorneys involved, they can reorganize things and structure it the right way so that that all works out fine for you. And a buyer will oftentimes increase the purchase price a little bit by what's called a gross up to compensate you for paying a little bit of extra taxes because they get a benefit out of it. But the key thing here is that you don't want to agree to things that, if they require your continued employment in the company, would make any part of the proceeds that you get either now or in the future look like ordinary income. Because, that's a lot higher tax rate than capital gains, right? So there's pre-planning that can be done to make sure. And then when you get the structure, when you get that letter of intent, you can go through with your attorney and have a tax advisor weigh in then too, to say, how much of these proceeds are subject to higher rates of taxes and how can they be minimized? And this is best negotiated at the letter of intent phase, can certainly be modified when it gets right down to it in the purchase agreement phase, but it's even better to address it right up front, or at least to signal an intention. Like, I'm open to retaining equity, but I understand that there's an amount of equity that if I haven't retained enough, I may pay taxes on that retained equity at the same rate as if I'm being paid in cash, right? So you don't want that to happen. You don't want to get 80% of the proceeds in cash, but pay taxes as if you got 100% of the proceeds, because the equity could drop in value and then you would have paid taxes on money you never actually got. So you need to work on this stuff with your tax advisor. But as a broad rule, you're going to pay capital gains tax, and you may pay some additional sales tax that can be negotiated so that the buyer picks up some of that bite. And then in rare cases where you've got a unique situation, like you converted a couple of years ago from a C Corp to an S Corp, there's going to be different rates of taxation depending on how close that was to the transaction. There are firms out there that might even insure you on a differential on different disagreements on taxes. So as far in advance as you can, start to do some of this tax planning, especially as it relates to anyone who's going to have a taxable estate of $25+ million. And then also, in the process of developing the letter of intent and agreeing to the purchase agreement, get the tax advisors involved there too. Minimally, you're going to pay capital gains tax. There might be higher taxes, but you can probably minimize those too with the right structure. Okay, again, not a CPA, but that's a general idea of what you're going to pay in taxes. Thanks. We're almost done with the funnel. You're almost done selling your company.